We have a crisis coming up, and I believe it's coming up soon. If it doesn't come up before the elections, it'll be sometime soon afterwards. And we already know the playbook.
We are in an economic depression, and at the same time, I think we're in an economic boom. It all depends on who you are.
The real hurdle rate as a business owner, the real rate you have to beat is the rate of debasement, the rate of monetary inflation, plus price inflation, plus probably a risk premium. You're like a 14, 15% hurdle rate. So then you just ask yourself, well, what can I invest into to get that type of a return?
But I do want to ask a one-word answer, Mike. Gold or silver? So we're going to dive into some heady stuff here today, but I want to start first with kind of a high-level, let's call it an easy question. And I'm going to make it a two-part yes or no question. We'll keep it pretty quick. But I often get asked, are we in a recession? And I know it can be a complicated answer, but I'm going to ask that in two ways. So do each of you feel like currently, today, and I know this can be a complicated answer, but let's stick with close to yes or no plus a little bit of commentary. Are we currently in a recession? And equally as important, the way recessions are called in this country, National Bureau of Economic Research, NBER, generally makes that call months or years after the event happens. Looking back, let's say a year or 2 or 5 from now, do you think NBER is going to say, as of today, that we're in a recession? George, do you want to kick us off?
Yeah, and keep in mind they always revise the numbers.
Absolutely.
So if you want to use today's GDP number, you really can't do that because NBER comes back a year later like they did in December of 2008. They say, oh yeah, by the way, all those numbers that we told you about GDP growth in the first quarter, they were all bogus.
And even ignoring GDP because, I mean, as we know, you can have 2 quarters of negative GDP and not have a recession. We saw that in 2001. You can have...
Well, I would argue that was still a recession.
Fair enough. So,
but yeah, to answer your question, I think we are in an economic depression, and at the same time, I think we're in an economic boom. It all depends on who you are. So if you're someone that owns assets, I don't think there's any getting around the fact that you are experiencing an economic boom, and you're seeing your purchasing power increase dramatically, even against the rate of consumer price inflation, or what they state is the consumer price inflation. But if you're an individual that doesn't own assets, I think it's literally the Great Depression. I mean, I was just in Tucson, as an example, and it is quite literally a zombie apocalypse. I mean, there's people walking around with needles hanging out of their arms. I mean, that's no joke. You know, you go down there, you look at the bus stops, and it's filled with people that are smoking crack. You can't even go to a park down there because they're just homeless camps. I mean, this in my, you know, I wasn't around in the 1930s, but I would have imagined that that's what it looked like. And people say, well, there's no food stamps and bread lines there. That's because people are getting these transfer payments from the government, right? But then you go over to where Mark lives in Southern California, and it's like people are driving around in Lamborghinis and Aston Martins and Bentleys and all these things, and you know, their home price that they paid, or their home that they paid $300,000 for and only put down, let's say $10,000 in 2010, is now worth $4 million. And they're feeling great. Their stock portfolio has gone up 3 times since COVID. So it really depends who you ask. And I think the bigger question is, if we have an economy that's completely built upon asset prices, how long does that last, right? Because at some point, those asset prices have to reflect the overall economy, not just the people that own those assets. So that's how I would view it.
I absolutely agree, and my presentation is that's coming up right after this is largely about that. But all you have to do to see if there's like a general recession going on is what do restaurants look like midweek? And I've noticed that there's been a huge drop in the amount of people going out to dinner. What do the malls look like? That's what the average person is experiencing. And you are absolutely right. The assets have appreciated so much that it is a boom and a recession or depression at the same time. Now, the dynamics of it are a little bit different because people don't know that in the Great Depression in the 30s, people were a bit more civil, I believe, than they are today. We don't know our neighbors anymore, and we're not reliant on one another as much. We are the people that are down on their luck or just don't care, the ones with the needles hanging out of their arms. They didn't have those guys back in the 30s. I think that it's going to be a much more dangerous event just because of the way the population is now. People don't get to know their neighbors. They don't work with each other as much. And so I don't think they're going to try and take care of each other as much. They're going to be a lot more ruthless this time around. So what's your opinion?
Yeah, I would say, I mean, I agree with all that. I think, as George said, I'm in Southern California, and where I live, we don't see a recession at all. I mean, I see $5 million homes getting snapped up with 13 offers in 24 hours right now, today, like literally this weekend, one around the corner from me. So I see that. I see the restaurants and the malls packed out. Not maybe the malls, because people shop online today, but I think that's happening. One of my friends, he builds up in LA. He builds all the retail stores for the high-end stores, the Burberrys, the Gucci's. He couldn't be busier. I mean, they're building at an enormous rate. So you see that side of the economy doing really well. Then you see, certainly, as George said, the homeless people, again, back in California, we probably have the largest homeless population, so you see that as well. So I think it's this bifurcated economy. Technically, to answer the question, no, we're not in a recession. Technically, no, right? GDP growth is still good if you trust the numbers, which of course we don't. As George said, they revise those numbers. We just saw what happened with the jobs report. You know, the BLS report kind of revises the numbers for almost every report they put out for the last couple of years. So technically, no, we're not in a recession. However, as George said, for some people it is. And I think as we continue to talk right here, just kind of keep this in mind. If we talk about CPI, inflation, we're going to talk about inflation later, we're talking about growth. These are complex subjects that you have to kind of dive into, and they affect each one of us differently. So it's not like a broad thing. Like some of you are in recession, some of you aren't. That being said, you know, I would say the answer, no, we're not in a recession. But what we are in is we're in a societal recession. And that's a whole nother topic, which is the homeless people that we have and people not watching out for each other. But that's another subject.
Where do you see inflation going? Are we going to be in a cycle of high inflation for the next 10 years?
Yeah, again, so kind of dive into this. So one, we'll just break out consumer prices versus asset prices. So most economists wouldn't consider asset prices going up inflation, so that's like appreciation. But most of us probably consider that inflation. So I'd say, you know, whether it's the median U.S. real estate, S&P 500, other assets, gold, Bitcoin, et cetera, I see those going way up, right? To your point, the amount of monetary debasement that we're seeing and continuing to see, the CBO projects out what they expect that to be. Yesterday, they put out, the Fed said that they think they're running a GDP or a deficit of 8% of GDP. I mean, that pushes the national debt up to $40 trillion by next year. So we'll see asset prices continue to go up because of that. Now back to consumer prices though, again, right, each one of us is affected differently. So if I live in my mother's basement and watch Netflix, it doesn't really affect me that much. But I would say overall, I'm a huge inflation bull. I believe there's going to be a massive amount of inflation. I believe asset prices, U.S. median real estate, et cetera, S&P 500 will be up 50% in 5 years from now. That's the number I put on it, and that's just at the rate of monetary debasement. I think also, as far as consumer prices, those also go way up, and that's not a number thing. It's more of a geopolitical thing, right? The world's breaking apart. The U.S. is trying to re-onshore and nearshore. That's going to push prices up. The world's going to continue to break apart and be at war with each other, which is going to continue to push down supply chains. So we're going to see both demand going up from monetary debasement. We're also going to see supply dropping because of what's going on globally, as well as, like I said, retooling, onshoring, et cetera. So get ready for a much more expensive world, in my opinion.
Anything to add, Mike?
I agree with all that, but to see where inflation is going to strike next, you know, every dollar created has to go somewhere. And if you watch bank reserves and base currency, that's the currency that goes directly into the financial markets. The Federal Reserve is handcuffed by the Federal Reserve Act. They have to buy securities through a network of primary dealers, the biggest brokerage houses on earth, and those securities have to be guaranteed by the U.S. government as to the principal plus the interest, and that means U.S. Treasuries, mortgage-backed securities through the world's biggest brokerage houses. So that is the way the Federal Reserve is creating currency, and because of the process, a mirror image of the banking system has a separate monetary system, where every member branch of the Federal Reserve System has a checking account at the Fed, and that base currency, those bank reserves, never leak out into the public. They all do settlement at the end of every day, and it only took 40 to 50 billion to run the financial system smoothly up until Ben Bernanke's ideas were implemented, and we started Bernankenomics, I call it, in 2008. And the economics of the way the monetary system is run is entirely different than before 2008. But when you see bank reserves increase, you know that asset prices are going to increase. When you see M2 increase, which includes bank credit, which is the vast, vast majority of all of the dollars that exist, those are the dollars that we use. And so then you will see, with a lag, retail prices. But the definition of inflation used to be an increase, or deflation, a decrease, in the currency supply. It wasn't. The government has sort of distracted us by putting together a basket of certain goods and services that they're measuring, but those goods and services have nothing to do with asset prices. Inflation is the creation of currency, and wherever that currency is directed to first is where you see that particular sector inflate or not. And so I think in the future, we are going to have an even more bifurcated society because we have a crisis coming up, and I believe it's coming up soon. If it doesn't come up before the elections, it'll be sometime soon afterwards. And we already know the playbook. What's going to happen is there will be massive currency creation, which causes the financial markets to go up, and then they'll drop interest rates to zero, and with a lag, real estate will go up.
We're on a panel called Inflation and De-Dollarization, so I think we'd be remiss if we don't at least touch on the strength of the dollar. So we've got some smart people on one side of the fence. Brent Johnson, I think a lot of us have probably heard of if we follow macro, has talked about the fact that because most of the global debt is denominated in the US dollar, because of the strength of our Fed, because of the strength of the dollar, basically the US is likely to suck up liquidity from the rest of the world over the next 3, 5, 10 years, to the point that we would probably debase every currency, not to use the word debase, but to the point where we probably weaken every other currency on the planet, to the point where we have to restructure global economies. On the other side, we've got a lot of credible people saying, hey, you have the BRICS alliance that are starting to trade in their own currencies, or thinking about trading in their own currencies. We have the petrodollar that is moving off the USD potentially. And we have other things like Japan starting to defend their currency. We see the yen carry trade, which isn't necessarily related to the strength of our dollar, but certainly impacts liquidity of our markets. So when we have these kind of, again, pressures on both sides, liquidity flowing into the US, liquidity flowing out, dollar strengthening, dollar weakening, where do you see the dollar going in the next 5 to 10 years? Is this something that should be a major concern for us, or are we thinking 10 years down the road we're still going to be the reserve currency and there's no second? Mike, do you want to start us off?
I don't care.
Fair enough.
You're talking about, is it going to strengthen against what? You're talking about strengthening against other currencies. That's what Brent Johnson is talking about as well. Gold was $253 an ounce in 1999. Now it's $2,500 an ounce. The gold didn't change. The dollar changed. The dollar has lost 90% of its purchasing power against gold. I bought 900 acres in Puerto Rico, and I'm developing that 900 acres into a productive farm with a very profitable business model. And there's a 300-acre valley that's just pristine, untouched. And I'm going to be developing that into sort of a natural resort. So I'm preparing for the worst while planning on the best. I'm trying to do a straddle, basically. I really don't care whether the dollar goes up or the dollar goes down against other currencies. I've put myself in a situation where it won't matter. I will do well in either scenario.
And that's fair. But
Yeah.
here, I think I'm making the distinction between a personal security issue, our assets and our own financial well-being, and a national security issue. So what's good for the country and what's good for our currency, if the dollar weakens against other currencies around the world too much over however long, that's bad for our country, that's bad for the global economy, that's potentially bad for our currency and
If
our
it
central bank.
weakens, if it weakens, you said?
If it weakens too much.
Actually, that's good for our production.
Certainly, to some degree.
In fact, during the Great Depression, that was the goal. It's called the bigger thy neighbor policy, where everybody is devaluing their currency to try and get more business going and get more exports going. So a weaker dollar can be very good. It's just that it's good and bad for different sectors. And this is the problem with all these fiat national currencies, is all these different floating exchange rates. When we had a one world money, gold, and we were on an international gold standard, the exchange rates were all fixed, and you could invest in another country or import and export goods and services, and you could project out pretty accurately a decade or whatever where you're going to be. You could make business plans. This is the problem that I have with all these national fiat currencies, is we're always caught off guard. We never know what the future is going to bring, and you don't know if some decision made by some politician in another country is going to crush your business or make you rich.
Yeah, which is why the dollar won't lose reserve status, because it's not controlled by government, and it's not controlled by a Federal Reserve. It's controlled by a bunch of banks that are outside the United States, that are outside the purview of the Fed. But what you have to ask yourself is, when you're dealing in currency, assuming that you have to, which we do, why do you choose one currency over the other? Well, number one, stability, right? Number two, you want liquidity. And then number three, you want network effects. So for those of you in the audience, how many of you have an iPhone? You go ahead and raise your hand. Okay, so the majority of you have an iPhone. One of the main reasons you have an iPhone is because you have access to all these really cool apps. How many of you would buy a smartphone that had no apps on it whatsoever? Nobody. Okay, so that's what we're talking about with the dollar and other currency. The dollar has all the apps, right? If any of you saw my presentation yesterday, you saw me talking about interest rate swaps. Okay, good luck doing an interest rate swap with the Colombian peso. Or the BRICS currency, I don't see any interest rate swap markets for that, right? So the point, and I could go on and on and on, but the dollar has the greatest network effects that we have ever seen in human history, if you understand the monetary system. Okay, so the probability of, and it's got the most stability because mechanically the way it's set up, right? We've been talking about money printing and whatnot. If you look at the difference between Argentina, let's say in the United States, the reason why one entity can have or lean towards inflation, hyperinflation, is because the majority of their currency units that they have were actually printed. And therefore, if you pay off your loan, those currency units still exist. So if there's no demand for the currency units, then the value of those currency units go down. But if those currency units were lent into existence, if the demand goes down, so does the supply. So there's this equilibrium effect that you have with the dollar to a greater degree than other currencies, which makes it, which leads to more stability. So you've got a better network, more stability, so the probability of us just transferring to another currency is very, very low. And another thing you have to ask yourself is, who's doing the transferring? You know, they sit there and talk about, well, Russia's doing a deal with China. Okay, fine, I don't care about Russia and China, right? All I care about are the entrepreneurs. I care about the multinational corporations, and what are they doing? So when you look at the derivatives market, and when you look at the currencies that are one side of each transaction, 95% is dollars. It's dollar-based, right? It's just these central banks that are saying, oh, we don't want dollars. And rightfully so. If I was a central bank, I'd be de-dollarizing as well,
Yep.
right? Because you don't want the risk.
Yep.
But they're going to gold and all these other things. But that doesn't mean that the entrepreneurs and the multinational corporations are going to do the exact same thing. I mean, you have to understand. Let's just say that Biden came out, or Harris, or whoever, and said, we're going to do a deal where we're going to settle, we're going to buy stuff from China, and we're going to start settling in yuan. What would all you do? Would you go out and buy yuan? No, none of you would. You'd still want dollars. For the main reasons, because most of your debt is denominated, or all your debt is denominated in dollars. Your expenses are denominated in dollars. You're used to dealing with the dollar, You're used to dealing with that network. So you're not going to go ahead and change and just deal with some other completely foreign system to you, right? So that's what you have to, and the last thing is you have to understand that the dollar has actually appreciated in value against most countries' goods and services, not just their fiat currency, right? So if you would have held dollars, as an example, in Japan in 2012, the value of those dollars would have gone up relative to goods and services because the dollar has gone up more than the against the yen more than their consumer price inflation, right? So why would you not hold a currency that appreciates 3% every single year, which, oh, by the way, you can get 5% by owning a treasury, so you're getting a net increase relative to your local goods and services of 8% per year. When you combine all those factors, you see how the probability is extremely low, and even if we do de-dollarize, it really won't impact the value of the dollar on the global market, which just reinforces its strength.
So, Mark, I know you want to chime in here. We only have about 6 minutes. I thought I was nuts when I only prepared 4 questions. I was like, I'm going to have to come up with some off the top of my head, and we've only gotten through 2. Real quick, and I'll start with you, Mark, because I think a lot of people out here are the big question on their mind and what they want to hear from you guys is, where should they be investing over the next 6 months, 12 months, 24 months, 10 years? Where should they be thinking about putting their money? What types of assets should they be buying for long-term growth and stability? Mark, what are you buying?
Yeah, so I would say, first of all, you invest in your, what Warren Buffett would call it, like his circle of competence or his deal box. So what are the couple things that you know, like, understand, have interest in, and focus on those things. You do not need a diversified basket of 20 or 30 different things that you don't know, care, or are interested in. So find a couple things that you understand, you know, like, you have an edge in. Probably most of you business. Maybe some adjacent businesses, not a random business, but maybe there's some other types of business you can do. Real estate, we're at a real estate conference. I think real estate works as well. But for me, I would say the one thing that you have to keep in mind, from my opinion, is it's not CPI inflation that you have to beat. Everyone's like, oh, 3% inflation, I can get treasuries at 5%, I have a 2% spread, oh, the S&P is up at 7.5%. No. It's the real hurdle rate as a business owner, the real rate you have to beat is the rate of debasement, the rate of monetary inflation, plus price inflation, plus probably a risk premium. You're like a 14, 15% hurdle rate. So then you just ask yourself, well, what can I invest into to get that type of a return? If you want to keep your head above water. And so for me, as I said, I'm a sound money advocate. There's only been 2 asset classes in the world that have beat that number over the last 14 years. One has been Bitcoin, 2 has been the NASDAQ. And that's it. Everything else has been below that number. So you could diversify across the whole basket, but you're diversifying into a bunch of losers. So think about it from that perspective. Obviously, in your own business, you're going to have your best returns. But how can I beat that number of whatever, 14%? Bitcoin's going up the last 4 years at 55%. We can go back to 15 years and look at. If anybody's managing their portfolio on a monthly or a yearly basis, you're probably not going to lose. He asked for a long-term perspective. No, you said long term.
Well, so certainly we care about that
You
shorter
said long
horizon, but the long-term horizon, I think, is the value that you guys bring is that
you asked
true
long term.
macro.
So I look at it like if most of you guys are real estate people. I developed real estate. Those are like 5-year projects. If you start a business, you're looking at 10 years. So I think you should be looking at least 5-year horizons. I think if you're trying to manage your money, certainly to your point, George, personally, I was building a house in Mexico, and I didn't put that cash into Bitcoin because I was afraid of the volatility and not having enough when I needed to pay my contractors. So for short-term money, certainly not. But over 4-year periods, there's never been a 4-year period where it's been down, to your point. When I've moved my unit of account, like he is on a gold standard, and you said, where do entrepreneurs go? Well, he went on to a gold standard. I'm on a Bitcoin standard. And so while everybody else is seeing prices go up and your life is getting more expensive, my life is getting cheaper. Homes are way cheaper. They got, from 2016 to 2020 to 2024 for me, priced in Bitcoin. And so I've changed my unit of account. That's my long term. It's going up by 55% a year. So real estate, Bitcoin, and my business. Those are 3 areas I focus on.
Thanks. Mike?
Precious metals, cryptos, and farmland. That's where I am at. And by the way, measured over the last since the beginning of this century, Gold is up almost 900%. The stock market, the S&P 500, is almost up 300%. Gold is one of those assets that you should be incorporating with the cryptos. I started investing in Bitcoin in 2014, and I'm one of the few precious metals dealers that recommends to my clients to investigate cryptos, and I do believe there is a financial crisis coming, and I believe the best performing assets are going to be precious metals and cryptos, and farmland is not in a bubble, and that is going to be a very needed commodity is farmland. And so,
yeah, a basket of gold and Bitcoin work really well. Ronnie Stoferle has done a lot of research into showing different weightings of gold and Bitcoin together.
About
in
a
portfolio
quarter of my liquid net worth is cryptos. And
So
I still have the original Bitcoins that I bought back in 2014. And when it was down at $250, I was getting 4 Bitcoins a week. And
So I want to give George a chance to answer this question. We have 2 minutes, but I do want to ask a one-word answer, Mike. Gold or silver?
Silver.
I wish we had more time. George.
Yeah. So I think we're in a commodity super cycle, but it doesn't mean you have to buy commodities right now, because I'd use an overlay of macro. I'd use an overlay of what the Treasury market's telling you, more specifically the yield curve, what I talked about yesterday. So I'm personally very excited about commodities over the long run, 10 years, let's say. But I'm not buying now because I want to wait to see how the yield curve plays out and see if there's better opportunities. I think what you have to understand is there's no one specific asset class to own, although I think everyone should own gold and everyone should own Bitcoin. Not just because I think the price is going to go up, because I think you need purchasing power outside of the current system for CBDCs and stuff that we don't have time to talk about. But the bottom line is you just got to buy things when they're cheap and sell them when they're expensive. So I don't know what is going to be cheap and what's going to be expensive over the span of the next 10 years. I just know that that's my process, and that I'm always looking for a catalyst, right? So if I'm not going to buy something just because it's cheap. Like gold miners are a great example right now. I'm not going to buy them just because they're cheap. They are, but I don't know if they're going to continue. I want a catalyst that tells me that now is a better time to buy based on the probabilities, even if I want to hold that long term. So I think that's what I'd encourage people to do. You got to be nimble. You got to buy things when they're cheap, sell them when they're expensive, but you've got to use a macro overlay to determine when the timing is right, because you do have to time these things to a certain degree, and then understand that over the long run, it's very, very likely that commodities will be much higher in price, even in real terms, than they are right now.
I have about 8,000 follow-up questions. I wish we had another 8 or 10 hours to dig in, but unfortunately our time is up. I apologize we didn't get to any audience questions. But gentlemen, this was a fantastic conversation. Please, everybody, make sure you check out their YouTube channels.